when we're looking at this in terms of how we're going to apply this to our trading, this morning I had the discussion with Tom and Tony. We went through some of the mathematics. We showed some of the formulas that actually compute this number. There's actually a number of formulas out there that compute risk of ruin. They're all pretty much the same. They're all generally the same. Like, is it really any different if you've got, Milwaukee's Best, if you've got some Bush, if you've got some Natty Light Ice? They're all pretty much the same. Obviously, Natty Light Ice is going to reign supreme, but it's not that big of an advantage. Same idea here with the risk of ruin calculation. Well, I did that this morning, so I'll link to that in the show notes so you guys can watch that segment and dive a bit more deeply into the mathematics behind what I'm going to talk about. What I want to do right here, though, is I actually want to take this idea that we're going to unpack on the slide here in a second, and I want to go into the platform and I want to show you guys a little bit more concretely how this would work out in your strategy selection. So Ryan, go ahead and bring us into the content here. All right, so what are the odds? The risk of ruin is a concept that can give you an objective foundation for your true outlier risk. Now, again, this is an objective measure. This is not based on subjectivity. This is not based on my opinion. This is not based on your opinion. This is not based on your favorite prognosticator's prognostication. This is going to be an objective measure that you will be able to attain and then use it as you see fit. I think there are two ways that you can effectively apply a risk of ruin calculation. You're going to either be looking at defined risk or you're going to be looking at undefined risk. And of course, these are going to be very, very different approaches because those two strategy buckets are very, very different, in their own rights. I would say, and this is similar to what we concluded this morning with Tom and Tony, defined risk, this is not really something that's going to be a problem for most, if not all of us in our trade. Now, if you've just gotten started, and you've got $10,000 in your account or $8,000 in your account or $3,500 in your account, or you're just getting going, then the reality is, a $300 vertical, like a $5 wide vertical where you're risking 3 to make 2. So you have $300 of risk in that position. That's significant for you. Like, I'm not trying to water that down. I'm not trying to pretend that doesn't matter, because it most certainly does. But in the grand scheme of your trading career, in the grand scheme of, you're making a lifetime out of this, it's ultimately only going to be a blip on the radar. And so from a defined risk standpoint, I don't really think the risk of ruin is going to be as applicable here, because this is something that can be easily mitigated with position sizing. When people talk about or think about the risk of ruin, they're most likely referring to undefined risk positions. They're most likely referring to, I'm selling a naked put, I'm selling a naked strangle. Like, I need to figure out what is the risk that this thing really blows up in my face. And so from an undefined risk standpoint, I think that's what we're talking about in regards to the risk of ruin. Well, here's what's interesting. We saw this morning. We're going to see it again right now in a couple of minutes when we go back into the platform in a slightly different way. It's very unlikely that you hit a string of outliers. It's very unlikely that you hit a string of outliers. You saw the mathematics this morning with Tom and Tony. So click on the So click or clink on the segment that is in the description if you're watching this after the fact. If it's live, then you don't have that yet, obviously. But if it's an hour or two after live, then it should be right down there in the description to the show. You can click on that link and you can go right to the segment that we did this morning. It's just not going to be a likely outcome for you. Now, there will still be times when it will happen to you because there is some clustering happening in the marketplace, or, you happen to have, a strangle on in NVIDIA, a strangle on in AMD, and a strangle on in Microsoft. You're like, hey, what happened? Like, why did all these things move together? It's like, well, I hate to be the one to break this to you, but those aren't necessarily diversified. Like, those are all kind of following the same, North Star there across the sea. And so when you think about, how you've built or structured your portfolio, this stuff matters in terms of correlations, in terms of strategies that you've selected, and all of those different things. But still, generally speaking, I think a good rule of thumb is it's not going to be very likely that you hit several of these in a row. Nevertheless, it's very helpful to be able to attach probabilities to, at least one of these things happening. Like, sure, we can go through the math, like what I did this morning. We can go through these equations and say, like, all right, I'm going to forget that 5 seconds after I've seen it. Or we can go right into the actual market itself, and it's going to provide the numbers for us. And I would argue a more practical way, a more pragmatic way that you can actually use. And as you're building out a strategy, you can say, all right, what is the likelihood that I hit this 2 standard deviation marker? So Ryan, go ahead and bring us back into the portfolio here really quick. So let me show you guys what I'm talking about here when it comes to the risk of ruin. So if we take a look at, and for those of you that are my overachievers out there, you read that green box that was on the slide that I just skipped over like it wasn't even there. I just pretended like it wasn't even there. It was a bit of a test for you all to see if you would look at it yourselves. Well, in that green box, I mentioned, another risk mitigation technique, or maybe I just forgot to mention it, and I'm now realizing that I forgot to mention it. In that green box, another risk mitigation technique, a very valuable one actually, would be to remember that, if you're trading indexes or you're trading, stable companies, then that alone is going to automatically whittle down your outlier risk. Like if you're selling strangles in McDonald's, that's not the same thing as selling strangles in AMC on the eve of a reverse split, mind you. Right? If you're selling strangles in SPY, that's not the same thing as selling strangles in, Snowflake. Right? If you're selling strangles in IWM, that's not going to be the same thing as selling strangles in, GameStop. Right? I mean, those are just very, very, very different animals. Strangles in Bed Bath & Beyond, which I think is now gone. It's actually defunct, which is making my point for me. And so if you really want to, if outlier risk does keep you up, like it used to keep Tony Batista up. And we shared the story this morning of how he used to get up at 3 or 4 o'clock in the morning and make phone calls around and, see where the market was at. If you're in a similar situation, whether you're making phone calls or not, you're like, man, I can't sleep at night. I'm concerned about my positions. Like, I feel like I'm taking on too much risk, like all those things. And I think one of the things that you could do that's a bit unrelated to what we're talking about here, but it's not unrelated enough that I don't want to bring it up, is you could focus on more stable companies and indexes for a while. Like you could focus on, the indexes, SPY, QQQ, IWM, DIA, right? Get a little boomer action in the portfolio. And then you could also focus on stable companies like, McDonald's, like Pepsi, like Procter and Gamble, like IBM, right? Like even, Microsoft, like Apple, companies like that aren't necessarily going to be exposed to as many huge outlier moves as some of the, less proven, kind of wilder brethren that are out there, like your GameStops, like your AMDs, like your NVIDIAs, which, I don't know if NVIDIA is not as proven, but it's crazy. It's absolutely crazy, NVIDIA out there. So if we take a look at this, if you see, I've actually been doing a little bit of digging around here in preparation for the show. I've got IBM queued up here in the recent symbols. So if I click on IBM, and let's see, if I go ahead and can I move this little box out of the way? There we go. So if I click on IBM, it's a box you guys can't see, but it's kind of in my way. So if I go into October, let's say I was going to set up a strangle. Now, this is very similar to a discussion that I had with Tom and Tony a few weeks ago on the probability of max loss. So I did another segment with Tom and Tony. It's very closely related to this one because when you're talking about risk of ruin, you're most likely talking about taking, a consecutive number of max losses. Like you're talking about, some big outlier moves against you. And so one of the ways that you can look at the probability of absorbing a maximum loss on a position is, let's say you were looking at IBM. And let's also say you were going to sell, I don't know, we could go like right outside the expected move. We could sell like a 140 put and a 155 call. And this is going to be basically an expected move strangle. Like this is very classic, very Betty Crocker-esque in terms of what we would do with one of our go-to strategies. So if I look at this, you can see my pop is 65%, which is good. My P50 is 85, which is also really good. You've got my maximum profit is going to be the credit that I collect on entry that I sell it for. The max loss, of course, is negative infinity because if IBM prints positive infinity, I will lose negative infinity. That's just the way infinity works. If you look at Delta is a little slightly skewed to the upside. Got some nice data coming in there on a daily basis, and then you've got a buying power effect of about $2,300. If I want to figure out the probability of a max loss on this position, here's essentially how you can do this. With the understanding that buying power effect, that $2,300, that corresponds to effectively, from the lens of the brokerage firm, from the lens of Tasty Trade right here, this is essentially the 2 standard deviation marker. They are saying, hey, we're gonna set aside the capital that would be needed to absorb a move out to the 2 standard deviation marker. So essentially, this is going to be 95% of the time you're not going to have to worry about this. 5% of the time you are going to have to worry about this. But rather than just talk about percentages and rather than just talk about kind of abstract equations and normal distributions and things like that. I want to go to actual prices in the marketplace so that we can concretely wrap our minds around what type of move this would mean for a stock like IBM. Again, we're not talking about, AMD. We're not talking about, GameStop. We're not talking about, these crazy movers out there that can do some really, really wild things in a short period of time. We're talking about IBM. I mean, the company's been around forever. The company's been selling for $146 a share for basically 14 years, right? So it essentially hasn't moved very much in well over a decade. So how do I figure out where I would be in terms of, the actual price level to get myself to having to absorb this type of loss? Well, here's what we're going to do. We're going to let me go ahead and clear those boxes away. And let's kind of start. Let's start again. And here, I actually want to use my final Jeopardy pen. So if I've got my credit collected of about $2, let's say, let's just round up to make it a bit simpler. You can see that my strikes are 140 and 155. These are all the numbers I'm going to use. These are the relevant numbers, the important information that I need to figure out where IBM needs to go for me to absorb this maximum loss, which of course is not my maximum loss. I mean, because it's negative infinity is the max loss. You can see that right here. But for all practical purposes, right, if things get really bad on this strangle with IBM, this is probably what I'm looking at in terms of a loss. So if I look at this, this would be my ruin on this trade. I can take my credit collected. I'm going to subtract $2 on that side. So that gets me to 138. I'm just going to write right over the strike bar because it's a little bit easier. That way I can leave all this information on the screen. If I take 155 and I add 2, I'm just, finding some basic break-even points. This would be 157. 157. So that's 138 to the downside, 157 to the upside. Now what I want to do is I want to take my buying power effect and I want to convert that to a per share basis because everything else is on a per share basis. This is my total buying power effect. But here I've got, strikes, that's per share. I've got, credits collected, that's per share. I've got, break-even points, that's per share. So if it's $2,300 and I have 100 shares in the contract, of course, this is going to be $23 per share. It's a little more than 23, but just to keep the numbers somewhat round, we're just going to use 23. So what I need to do now is I essentially need to figure out, so what would a $23 loss be on either side of the market? Well, once you have these numbers, this 138 and this 157, it's actually very simple to figure this out because all I need to do is take 138 minus 23, and that's going to give me 115 to the downside. So this would be if IBM gets to 115 to the downside, which is what? That's a $31 drop, right? And we're going to look at the probabilities here in just a second. Then I add 23 to the upside. That's going to get me to 180 to the upside. So I'm looking at what? A $31 drop or a $34 rise to get to the level in the market over the course of the next 53 days that would be required to get me to the maximum loss as determined by the buying power effect. Again, to be very clear, the maximum loss is negative infinity. But again, to get to negative infinity, you need IBM to print positive infinity. It hasn't been above 147 in 19 years. So I don't think it's going to hit positive infinity anytime soon, but theoretically it is possible. So if we look at these being my 2 points of interest, 115 and 180, let me erase all of this because now what I want to do is I want to say, all right, let me clear my drawings. And I'm going to center up the screen a little bit. Well, actually, no, I'll just do this. Let me minimize that. So 115 and 180 were my two numbers. So 115 is right here and 180 is right here.